Well, good morning. Good morning, everybody. Welcome to day 3 of our Raging Profits with ETFs 3-day challenge. Hope you guys are all doing fantastic today and ready to jump in and learn some stuff to kind of put the cherry on the top for the last couple of days that we've been working on this. It's great to be with you today. As you know, these examples are for educational purposes only, intended for these purposes, and should not be considered specific investing or trading advice. All examples are for the purpose of teaching, are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. There you go. Consider yourselves disclaimed. Now, what I want to talk about today, what we're going to talk about is cash flow. Cash flow is king. Whenever I teach my Designing Your Financial Fortress training, cash flow is the major topic, because cash flow, if you've not heard me talk about it before, I'll explain it to you, that cash flow is the engine of wealth. If you don't have cash flowing in, eventually everything dissipates. Cash coming into your business, into your life, whatever it is that you're operating, cash flow is king. We got to have cash flow. And another way of looking at that is a person can live, well, frankly, a person can live indefinitely without a net worth. In fact, most people do. Most people don't have a very big net worth, 100,000, 200,000, or maybe they have a decent net worth in their house, but they don't really have a lot of cash. That's where most people live. Most people don't have really big net worths. And you can live your entire life, 70, 80, 100 years, and have very little or zero net worth. But you cannot survive even 2 weeks without cash flow. Homelessness is caused by a lack of cash flow, not a lack of net worth. And so cash flow is king. And what we want to do is we want to find different tools, different vehicles that we can use to keep cash coming into our lives, keep cash coming into our business, into our trading accounts in this case. But just because it comes to your trading account doesn't mean it's not living expenses. You can trade for a living. You can trade and have that cash flow coming in every week, every month, and use that for your income. So that's what we're going to talk about today. In today's session, we're going to talk about market cycles. We're going to talk about a bear market plan, a sideways market plan, and I'm even going to share with you a strategy where you get paid first. How cool would that be? What if you find a trade, you're like, I think I'm going to take that trade, but before you buy the stock, before you buy the ETF, you actually collect the money up front and you get paid first. That's pretty cool, right? I'm going to show you that strategy, and we'll kind of talk about what the next steps are. This is day 3 of the challenge. As you know, if you've been here the last couple of days, on day number 1, we talked about beating the pros. We talked about the truth about your funds and so-called professionals. We introduced you to the exchange-traded fund. We gave you a very simple and very effective trading system and a plan to beat the so-called professionals. On day number 2, that was yesterday, we talked about diversification with your ETFs and spreading your risk out. I gave you an ETF diversification model where you trade or you spread it over 5 ETFs. And it's an extremely, extremely lucrative and beneficial model. And then we talked about some portfolio management. And today, like I said, we're going to talk about cash flow, cycles, bear market profits, renting your stock, and getting paid first. Excuse me. Let's jump right in and talk about market cycles, and then we'll kind of back into some of these other issues of getting monthly cash flow here. Markets do not always go straight up, and they do not always go straight down. This is one of the big disinformation ideas, or it's not even disinformation, it's just people have this idea that markets can go straight up or straight down. They hear somebody say the market's going to crash, and they think it's going to just disappear, and it's just going to drop 40% in a week. That's not normally how it works. It can happen, but it's not normally how it works. Even during COVID, it wasn't quite like that. That was a major market crash, and it took less than 2 weeks. But that's very, very rare. And when you have that kind of a crash, usually in 9.5 out of 10 scenarios, it's going to bounce back within a very, very short window. And that's what you saw in 2020. Markets do not always go straight up. They do not always go straight down. They move in cycles, okay? The thing about cycles, as the name suggests, is cycles repeat. Cycles do the same thing over and over again. This idea of markets moving in cycles was first really codified, and I say codified, but it was observed, and we started seeing written material about it with Charles Dow in the late 1800s, right at the turn of the century. And so this is over 100 years now. We're pushing 150 years that this part of technical theory has been well known and well documented. A few years after the idea of markets moving in cycles, another market analyst came along by the name of Ralph Nelson Elliott, and he recognized that these cycles, not only are they repeating, but they're repeating the same cycle at various time frames. So the cycle that you see happening on a daily chart or on a weekly chart, that same pattern, that same market cycle is happening on a smaller time frame, such as a 30-minute chart, and then it'll happen the same on a 10-minute chart, and on a 5-minute chart, and on a 1-minute chart. It also happens going higher. The term we use for that is a fractal. It's a fractal relationship, and I'm not going to go really deep into this whole theory of how market action works, but just know that there is a theory to it. It's well understood, it's well documented, and the core principles are what you see on the screen here. Markets move in cycles, cycles repeat, and they repeat at various time frames. Knowing that, we can now get a better idea of what we can anticipate in the market. And let's just talk about that for a minute. A lot of times, whenever you listen to financial planners or the so-called fundamental traders, whenever they talk about the market, one of their favorite things to say is you can't time the market. There's a guy right now in Nashville, where I live, who does a radio show on one of our local talk radio channels. And every Saturday morning, so probably right now, he has like a 3-hour block. He's a financial planner. He has a 3-hour block where he comes in and he talks about all these financial things. And he's plastered all over the radio station, and he's advertising throughout the week. A lot of people in Middle Tennessee, where I live, give this guy their money. He says day and night, over and over, you can't time the market, you can't time the market, you just keep buying and holding and buying and holding and buying and holding. There's only one problem with that. It doesn't work that way. That's not how the market works. It's a naive belief to think that the market's always going to go up over time. It's a naive belief to think it's okay to see 20, 30, and 40% drawdown on your accounts. That man that I'm referencing, I have as a client of mine right now, a former client of his. And during the worst of the corona pandemic in 2020, my client left him and came to me because her retirement was down 40%. Her entire account. And she said, I don't know what to do. I'm down 40%. And for her, that represented over $600,000. Okay, so she was a millionaire, a healthy one, and now she was not. Because this man did not manage her downside risk. That's the naivety of saying we're just going to hold and keep going. Now, I know the market came back. I know. But it's not about what eventually happens. It's about the emotions of the people that are dealing with it. And what if? What if, 2020 it just happened to be one of those market cycles where we had a huge sell-off and then it came right back because of the circumstances that were surrounding it. The one we're in right now is different. The one we're in right now is a 20-25% drawdown. It's probably going to get worse. And this has been going on for 10 months. This is like, if that market crash was a sprint, this is a freaking marathon that's turning into a triathlon marathon. You can tell I don't run that much, but you get the idea. I mean, this thing is just getting longer and longer, and it's probably going to keep getting longer. So the question is, what if you needed your money at the market bottom? You don't have time to wait for it to come back 4, 5, 6, 8 years, however long it takes for it to come back. It's naive to think that we can just buy and hold based on fundamentals and everything's going to work itself out, okay? What we need to do is we have to look at the price action and we have to understand what's really happening. And as we saw on this slide here, there's predictable things. People say you can't time the market. Well, that's because they don't understand this. They don't understand the cycles. We absolutely, if you understand the cycles, if you understand what's happening, we can time the market and we can predict what's going to happen, at least within some sort of a relevant framework moving forward into the future. And I'll prove it to you right now. Excuse me. I need to drink something here because I ate a poppy seed muffin just before we went live, and I think I got a poppy seed stuck. So hold on 1 second here. All right, hopefully that will work itself out. If I say to you, what comes after summer? Your first reaction probably looks a lot like autumn or fall. What comes after fall? And you're probably going to say winter. And if I say what comes after winter, you're going to say spring. And if I say what comes after spring, you're going to say summer. Can I predict? Is it possible for me, as a little human being who knows very little about weather, is it possible for me to predict that after summer, it's probably going to get cooler and the leaves are going to fall off the trees? Yeah. Why is it possible for me to predict that? Because it's a cycle. It's a weather cycle. It's a climate cycle. We understand these things from nature. Is it possible for me to predict that after a cold winter, when there's snow on the ground and everything has died off, is it possible for me to predict that there's going to be a springtime and it's going to start raining and everything is going to come roaring back to life? And the answer is yes. Yes, it is possible to predict that. How can I predict that? Because it's a cycle. And in my 45 years, I've experienced about 45 of those cycles. I have seen it now enough to know it is a predictable repeating pattern. The market has predictable repeating patterns. Charles Dow in the late 1918s, the late 1800s, the 19th century, late 1800s, right before the turn of the century, Charles Dow started writing and observing on the market, and he came up with what are now referred to as the 6 tenets or 6 principles of Dow theory. This was all from observations, such as we watch, and after spring comes summer, after summer comes fall, after fall comes winter. Okay, well, the third principle of Dow theory says that the market or the trend has 3 phases, and those 3 phases are accumulation, public participation, and distribution. This is as repeatable as after spring comes summer, after summer comes fall, after fall comes winter. It is just as predictable. So if I know that markets are going to move through cycles that go accumulation, public participation, distribution, if I know that markets are going to do that, is it foolish for me to think that they will do something different? It is. It is absolutely foolish. Moreover, if I know that markets are going to go through this cycle of accumulation, public participation, distribution, is it wise for me to prepare? For example, if you know that summer's coming, do you ever buy summer clothes? Maybe some extra shorts, some short sleeve shirts. Maybe you buy a swimsuit because it might be a summer sport you want to participate in. Okay. If you know that winter's coming, do you maybe buy some different clothes? And maybe you get a nice warm winter jacket and maybe some extra firewood because it's going to be cold. We know these things, right? So let's talk through each of these phases. Accumulation is going to happen at the bottom of the trend. It's going to happen after a sell-off period. And this is when the informed investors begin taking on new positions. The stocks appear very bearish, and the news and the sentiment is very, very bad. Trading volume is usually very, very low. And for the most part, the interest in the market has dissipated. I can tell you right now, if you go look at your charts, the crypto market is in an accumulation period. If you've been watching the crypto markets lately, you've been watching Bitcoin, XRP, Ethereum, they are in fact, we'll just go look at it really fast here. No, I'm going to do that in a minute. I'll come back to that. They are in an accumulation period. I'll come back to that if I forget to chat it in here and remind me. All right. Next phase is the public participation phase. This is when the participation begins to pick up. The public starts to jump on board. Who's in the informed investors? The informed investors are those who, for whatever reason, through their various forms of analysis or through inside information or whatever, they were able to recognize the market bottom and they started buying at the accumulation period. They started taking on new positions. As the market starts to react to that, as the value starts to increase because money is flowing into it, as that's starting to pick up, volume starts to increase and the public starts to awaken to the reality that, hey, things are moving again. When the public starts to awaken, that's when we can move from price point A to price point B. Prices begin to rise, confidence starts to come in, and the more momentum we build, the more it begets more momentum. When we get to the peak of the public participation, the news is very, very optimistic and prices end up driving to the next level. Now, depending on which fractal you're on, whether it's a very small time frame or a larger time frame, the public participation period could be very short with relatively small news cycles to go with it, or it could be very big, very long with many cycles within it. So this can be a very big phase of the trend. The keys to recognize in a public participation period is at the bottom, the news is very, very bearish. It's only as the public participation evolves that the news starts to change their cycle and they start to change their story. And suddenly, when you finally have the most bullish news, when the news is the most optimistic, the most excited about the market, that's when we get to the third phase of the trend, which is the distribution phase. And what happens in the distribution phase? In the distribution phase, the news is extremely bullish, and this is where optimism is at the most high. Everybody is almost euphoric, and the previous fears that people had before, they're just totally gone. People aren't even worried about it. And those very same informed traders that started the market move when it was down in the accumulation period, they began to sell their positions. And we call it distribution. They're distributing their profits. They're distributing their positions, and they're taking in their profits, cashing out, ready for the next phase, which unfortunately is going to go in the opposite direction most of the time. Now, there's other variations of this, but here's the punchline. Here's the basic idea. At the bottom, after a major sell-off, this is when the informed traders start to accumulate their positions. Remember, in this phase of the trend, the news is the most bearish. The news has nothing exciting to report. During this phase of the trend, the news is very, very pessimistic, and they're basically making people feel like they're idiots if they're buying into the stock, or maybe it's crypto or something else. But whatever it is that is accumulating, the news media, and it's not just the media, it's the actual news sentiment, is extremely bearish. And it's these informed traders, these informed investors that actually have the courage to start taking the position. It looks very contrarian. In fact, there's a lot of people that have a philosophy of trading where they say you're going to be a contrarian investor. You're going to take the opposite side of what appears to be true, because a lot of times that's how the market works. The general dumb money, as they like to call it, is usually on the wrong side of the trade. It's the smart money that's accumulating at the bottom. Okay, so after the accumulation period, news is very, very bearish. And we start to get a little bit of momentum. As the momentum starts to build, we have a breakout. And this is when the public starts to recognize what's going on. They start to jump in. It starts with the more aware public participants. A lot of you people listening right now and watching, you're going to be some of those participants. I try to teach my students to get in at the beginning of the public participation phase. If you can get in at the beginning of the public participation phase, you're going to make the most profit the fastest. You'll have the fastest ROI. You'll have the fastest momentum in your trade if you can jump in at the beginning of the public participation phase. Okay? But the key here is this is when the public is starting to get on board. Now, we often talk about market manipulation. Markets are manipulated. Don't ever believe that they are not manipulated. They're manipulated by funds, primarily by big money funds is the biggest way that markets are manipulated. They're also manipulated by governments. And our own government, the United States, manipulates the markets. Here's the thing about market manipulation, and we see a lot of it happening right now, like as we speak. It's been happening this week really, really intensely, and last week. It's easy to manipulate a small percentage of trades. What you're doing when you're manipulating the market is, it might be down here. This happens a lot at the accumulation phase. They'll start buying a whole lot to see if they can get the public involved. And when the public looks at it and they're like, oh yeah, things are going, the public starts putting their money back into it. That's what you see happening right now, by the way. This is what's happening in the market. This is why you see the Dow 30 rising and the S&P and the NASDAQ are not. Because it's easy to buy 30 stocks and get them looking like we're having a really big day. So last month we had supposedly, the best month in 40 years. Well, that's because the Dow was being manipulated, and they're buying these 30 stocks, they're pumping all this money into it to try to get volume going, try to knock some of the public participants off the fence and get them to put more money into it. The S&P and the NASDAQ had a hard time following. And what do you see? When that manipulation stops, boom, the bear market resumes. Why? Because it's manipulation. What you need to understand about market manipulation is it can help define the ranges of the market, such as the accumulation, such as the distribution phase. It cannot drive us. Market manipulation, there's not enough money. You have to have the public involved. The public has to be there to drive us from point A to point B. Okay, so now once we move through this phase, we eventually get to the top, and this is where the distribution phase starts. Those same informed traders who started the move, they start to take their profits. Now, what happens after the distribution phase? Well, it evolves into one of two phases. It either evolves into a bearish public participation phase, or it evolves into a reaccumulation. The people who started the move, they distribute their profits. This is where a lot of manipulation happens as well. They'll start selling, and as it gets stuck in the sideways move that we call a channel, as it gets stuck there, a lot of the big money funds will start buying at the support level here to see if they can get the public participants to kind of push it higher, or they'll start shorting and then kind of going back and forth, seeing what they can do to try to knock people off the fence. And then eventually it breaks. It breaks one way or the other. It might break out into a new public participation to the upside, or it might break to the downside. But whichever happens, eventually we have another wave of momentum. The public comes in, starts to drive the value again. If it's the bearish momentum, then eventually it ends with a panic and everything starts again at the bottom with new accumulation period with all the same characteristics. So what's the point here? Why am I showing you all this? What are we trying to build from this? Here's what you need to understand about these phases of the cycle. This, number one, it's fact. Number one, it is fact. That's the first thing you got to understand about the cycles of the trend. You don't get a choice. I don't have a choice when I wake up and spring training for baseball happens in the spring. I don't have a choice that we're about to go through a long, hot summer, and then we're going to get into a fall, and then we're going to have the World Series, and then baseball stops for winter. I don't have a choice. That's just how it works. Every year, that's how it goes. It's the cycles of the season. We don't have a choice with market cycles. They will happen, whether we like it or not. So rather than try to come up with some fancy marketing ideas that we're going to dollar cost average and we're just going to keep holding for 20 years and eventually the market always balances itself out and all that junk, rather than that, how about we learn to recognize the cycle and understand it and learn to profit from it and learn to increase our cash flow during it? So it's three directions of the market. Understanding that traditional strategies only work in one of the three directions. Traditional strategies teach you to buy when the trade is going up, and traditional strategies teach you to hold and suffer while the market's going down. I do not teach you that because I think it's foolishness. Doesn't make me happy, don't make you happy, don't make nobody happy. We have to have a better plan that involves working with these phases, right? So I said I would come back and I would show you what's happening with crypto right now. I'm going to do this really quickly because it's very relevant for where we are in this conversation. Let me get rid of some of these things so we can see a little bit more clearly. And you can see very, very clearly. First of all, if you've been paying attention to the crypto markets, you remember in late 2020, early 2021, Bitcoin, which is what you're looking at here, we traded all the way up here to over $60,000 for a Bitcoin. Wow. Incredible. This thing started at pennies, and you know, the first one was for however many Bitcoin it was to buy a pizza. You remember that? Now suddenly it's $60,000. 2 Bitcoin can buy you a cheap mobile home. Wow, it's incredible. And then it crashed. And then it rallied. It doubled back to over 64,000. And that was the end of 2021, at which point Bitcoin has gone nowhere but down. So now Bitcoin is at 20,000. That is a 60% loss. It's down substantially. All of crypto is down. And what do you hear in the news? Nothing. How bullish are we? We're not. People are very bearish on crypto. Some people are saying it's the end of crypto. Some people are saying it's just another tulip bulb mania gone bust. If you don't know that story, oops, no, there you go. Back in whatever year it was, 1500s or whatever, in Europe, they had this bright idea that tulip bulbs, like little flowers, were worth a lot of money, and people would start buying them and paying just, 2 or 3 generations worth of a lifetime fortune to buy them. Just total bubble. And it's known as the tulip bulb mania. Of course, it came crashing down because flowers had no value. Anyway, we're at the bottom. The news media is extremely, extremely bearish. And what you see here now going on for several months is an accumulation period. Accumulation. What drove us down? Up here, we had some distribution. We had some distribution over here. And then we had kind of that last gasp of exhaustion, distribution. This was your bearish participation, public participation right here. And now we're reaccumulating. Folks, if there's a time to be looking at Bitcoin, this is the time. As soon as this thing breaks out, where do you think it's going? It's going right back up. And all of our crypto looks the same way. All of it. That's how market cycles work. So don't get caught up in the news cycles. If you've been around me very long, then you're going to learn that I don't even pay attention to the news. I don't even have television. I mean, the only news that I see is whatever I take off the internet because I'm searching for it. But I'm not really affected by the news headlines very much because I don't pay attention. I don't give them that power over me. This is the truth of what's happening with our market cycles. If we look at the Dow Jones Industrial Average, we are in a bearish market here. This was the 2020 crash. Okay, once it recovered, look, there's your distribution and reaccumulation, and then here was your public participation. Here's your distribution at the top. And it's been a very slow roll, but we are in the middle of a bearish public participation. How bearish is the news right now? The answer is not bearish enough. The news is not bearish enough to be the bottom. How bearish was the news back here at the bottom of COVID? Oh, it was bearish. It was bearish. They were talking about the worst depression in the history of the United States. They were talking it may take decades to recover. Of course, we came back very quickly because that was not a nice, orderly bear market. This is a nice, orderly bear market. How long will it last? It can last a long time. All right, I've driven that principle home. Let me see, what am I going? Here we go. Let's try this right here. So we need a plan. We need a plan. By the way, let me go on a tangent here, if you will. Yesterday, after we did our morning session, I had several coaching calls yesterday afternoon, and one of my clients, we got to talking about her portfolio and the so-called professional who's been working with her over the last 20 plus years, since the late 1990s. So quarter of a century, 25 years, he's been managing her money. And over those years, her account has not gone up. He's a bottom 95%er, right? Her account has not gone up. She's not been withdrawing from it, just managing to kind of stay flat and sometimes go down just a little bit. So I shared with her in great detail because, you know, all right, if you're watching this, I think we're live again. Let's see if it picked up. If you're watching this live, give me some feedback in the chat and tell me if everything just shut down the stream. I don't know what happened, but let's try this and see if we're getting some live feedback here. I think that this is the right one. That may have loaded a different one here. Let's see. If you guys are live and you're watching this, give me some feedback that you're getting the stream running here. Back up now, says Daniel. Okay, good. Let's see if we can see what's happening over here. That was just the weirdest thing. Like, it just literally said stream died, session ended. So weird. All right. Well, if people are over on YouTube, I don't know. I don't think they're going to get it. So it'll just. That's why you come to the main site, right? Come to the main source. All right, so you guys are back. Great. Well, let's give it a couple minutes here for people to refresh the page. We won't give it a couple minutes. We'll give it about 10 seconds. And I think we're good. Sorry about that. I'm very, very sorry. I don't know what happened. I've got a hardwired Ethernet connection for the internet, and I just checked it, and I've got like total, we have fiber internet, so it's like 500 gigs or 500 megs, whatever, just insanely fast. Something just stopped, so who knows. All right. Now I forgot what I was talking about. Let's see. I was talking about my coaching session yesterday, and we went back in time and we did the whole strategy that I shared with you yesterday, where we are using the SPY, the S&P 500, just buying when it's bullish and rotating over to the treasuries, and then going to cash whenever neither one of them are bullish. That one little strategy right there. Okay. And we went through and we timed it. And then I specifically shared with her a different ETF that trades the SPY. It's a 3X ETF. And the ticker is SPXL. So if you've not looked at that, you can look at SPXL. And so I shared with her that ticker, and we did that whole historical view. We just went and said, when we're above the averages, what if we buy here? And then running that forward, if we used a $100,000 allotment, and we said, what would she be at? And it was going to be like $350,000 is what she would have grown her account to over about 3 or 4 years. It wasn't a huge time frame. She's ecstatic about that. And I said, but you know what? We really need to redo this, because the question is, when you cash out at the top, do you reinvest at the bottom? So we went through, and every time we went to cash, when we bought back in, we bought as many additional shares as we could afford with the new profits. And by reinvesting those profits over that same time period, we turned her $100,000 into $1.3 million. Just using this little strategy that I taught with you yesterday. Now, I want to be clear, I did that with the SPXL fund. It was the aggressive, very, very aggressive version of SPY. And that's not, documented historical back testing. It's not, we didn't do that in a real money account. It's just kind of going through and saying, here's where the signal was. What if we had done this here? And what if we'd done that there? So I want to be very clear about that. But here's my point. The reason that we need to understand these market cycles, the reason that we need to understand how things are operating is, number one, it's happening. Number two, that's where the money's made. If you know, let me see if I can get back to my cycle here, my picture here. If you know that we're going to go up and then we're going to come back down, why would you hold for a 20 or 30 or 40% drawdown when you could cash out at the top, and when you get back to the bottom, you can buy that much more? That's how you compound growth over time. If you just buy and hold SPY, you're going to beat the professionals. Over that same time period, just buying and holding SPY would have generated like a 20-something% profit. If you rotated into treasuries like we talked about yesterday, it would be about 50%. And then if you supercharged it with SPXL, like I was explaining to you, she was over 300,000, 350,000 or something. But when we reinvest all those profits, recognizing these cycles, 1.3 million. Do you think it's worth to learn these market cycles? The answer is absolutely. So let's talk about a bear market plan. Yesterday, I gave you a plan for just going to cash. And frankly, that's a million times better than what most people do. Most people just hold and suffer. I don't know why society is conditioned to suffer, but most people are just content to suffer. I'm not. I don't like suffering. So that was the idea yesterday. It was just when things turn bad, just stop the pain, go to cash, right? I want to give you a new strategy today. What if we could supercharge it even more? And let me help you understand. When you're in a bear market, there's only a few strategies that we can use. The primary one is a short trade. When we short the market, we do the opposite of buying the market long. When we short the market, what we're doing is we're actually selling before we buy. You say, can you do that? And the answer is yes, we can do that. We have to be able to do that. It's part of how the free market operates. So regardless of what your personal opinions might be on short selling is a very important function of the market. It's a very, very important function. And outside of the equities market, outside of stocks, where the media and financial planners and, those kind of people, where they like to manipulate the belief of the market, outside of the equities market, short selling is not just an accepted fact of how we operate. It's expected. You cannot trade the foreign currency market without also shorting it at the same time. It's impossible, because when you buy a foreign currency, you're shorting another currency. You have to do that. That's how it operates. When you're trading in the futures market, you have to have an equal number of shorts to the long positions. Okay, so you have a long futures contract. Well, somebody had to short that contract. It's how the market functions. Selling in the market and shorting, being on the short side of the market, is a very natural function. In the equities market, it's a very natural function too, because it provides liquidity and it prevents these runaway bubbles. In fact, one of the reasons that we've had these runaway bubbles with, oops, I pushed the wrong button. Let's try this again. One of the reasons we've had these runaway bubbles with Bitcoin and crypto is because of the lack of short selling. So how can Bitcoin go from less than 10,000 to over 60,000 and come crashing back down to 20? The answer is that market does not have enough short sellers. If it did along the way for that bubble, you would have had short sellers coming in, providing short liquidity, and it would have helped suppress the price and kept it in a more fair balance. So I only say that. I'm not trying to get down the short sell rabbit hole today. I just want you to understand that selling short is a very important function of the market, and it is a bearish trade. And when you're shorting the market, you're expecting the trade, you're expecting the market to go down, okay? There's another technique that we can use, and it's basically, it's a derivative. It's taking a less committed short position, and that is through the use of what we call a put option. What a put option is it gives you the right to sell, or in the case of a bear market, it's the right to short the market. We don't have to do it, it just gives us the right to do that. So that's a second strategy we can use. But the third strategy, one that has just emerged over the last few years as exchange-traded funds have become really popular, is the inverse ETF. And this is the one that I think everybody can get exposure to. It's very easy to do. It's zero difference in what you're used to doing right now. If you understood what I taught you the last 2 days, you can understand inverse ETFs. It's just so simple because all you're doing is buying the fund. You're already used to that, right? So what is an inverse ETF? An inverse ETF is just like any other exchange traded fund. It's identical, except the holdings, the asset that it holds, instead of holding a long position for all of the 500 companies in the SPY, instead of doing that, it holds a short position. The end. So you say, I want to buy into the fund and the fund is going to short my stock for me. Well, kind of, yeah. It's taking a short position, but you don't have to take the short position. What you're doing is you're buying a fund. You're going to buy a long position in the inverse fund. Now, hedge fund traders have done this for years. What we call qualified investors, for ever since the Securities and Exchange Act of the 1930s, whatever year it was, whenever they made it so that fund managers could not short your individual trades, you had to be a sophisticated, or what we call a qualified investors, which basically means you have to be one of the top 1%ers. If you're a top 1%er, then you get access to different strategies. Okay, one of those techniques is you can participate with hedge funds. What hedge funds are, hedge fund is a lot like a mutual fund in the sense that you're pooling funds together and then you're going to go buy assets. But the hedge fund doesn't have the same kind of rules that a mutual fund has. A hedge fund can be a short fund. It can be a hedge fund that only goes in and does short behavior in the market. It could be a fund that's, it could be really anything. Most of the hedge funds are going to have a specific strategy that they work through. They have very specific rules and they say, well, this is the fund that you're buying into and it's going to follow these rules. But a hedge fund manager cannot solicit to you unless you are a qualified investor. That means that you're going to have a certain million or multi-million-dollar net worth. You're going to have about $300,000 or more of annual income. It's got to be repeatable. You're a 1%er, okay? So if you're in the top 1%, you get access to different investments. The rest of the normies, everybody else out there, they're stuck with Edward Jones level financial planners who are in the bottom 95%, and they can't match the market until ETFs. What the ETF did is it gives you the opportunity to buy a fund, but that fund can hold anything. And in this case, with the inverse ETF, that fund is going to hold a short position in whatever it is that you're trading. I stopped talking because my stream stopped again on my laptop that I'm monitoring. Would you guys give me just a little confirmation that I'm streaming still? I think I am. I think the page glitched. There's a really bad storm outside. Maybe that's what it is. They gave all these wind advisories today, and we have really, really heavy winds. I could see maybe that's like causing fiber lines to get jacked up or something. Did you guys hear all that about the shorts? I think you did. All right. So here's what happens with an inverse ETF. In the inverse ETF, the fund is going to go up in value when the associated trade goes down. The fund goes up in value when the associated trade goes down. So if you're in an inverse fund for the S&P 500, when the market goes down, your fund goes up. But again, the cool thing about this is an everyday normal human being just like you in your Roth IRA or your regular trading account, your 401k, you can buy these ETFs just like any other ETF. And that gives you the opportunity to profit in a bear market. How cool is that? I think it's awesome. When I discovered these, I just about soiled myself. I just thought it was the coolest thing in the world. And I still think they're cool. I'm a very bi-directional trader, so I don't have a real problem. Like unlike a lot of people, I don't have an issue feeling like I can't participate in a bear market. But what I love about inverse funds is anybody can have that freedom, and they don't have to have that fear that, oh, I got to learn how to short. I got to learn to trade options. So this is just a great tool because it gives people access to all this. Take a look at this chart. On the bottom is SPY. That's the ETF we looked at yesterday. When the market's going down, SPY is going down. On the top is SDS. This is a short fund for the S&P 500. When the market is going down, SDS is going up. It happens to be a 2X fund, which means it goes up twice as fast. Okay? Isn't that cool? How useful is that? You can do this with almost anything. If there's an inverse fund, you can do it. Check this out. This is for treasuries. On the bottom is TLT. On the top is TTT. Treasuries was TLT is the treasuries ETF that we looked at yesterday. Well, look how much it's gone down in the last year and a half. But look what hasn't gone down. Across the top is TTT. Again, it's a 2X fund. Actually, that one might be a 3X fund. I need to go look at that. I think it's a 3X. But the point is it's gone up. And it's gone up 200% in 2022 alone. So if you had bought TTT when TTT started giving you those buy signals, we're up 200% year to date. Would you like to have some more of these funds? Here, take a picture. If you're trading the diamond, you're trading the Dow, the long fund is DIA, the short fund is DOG. It's a dog, right? Short fund is DOG, and the 2X short fund is DXD. Okay, so I put both of them up here. The single is just 1-to-1, and then the 2X is going to go twice as fast. It's just got leverage with it. S&P is SPY, SH is the inverse, and then SDS is the 2X. NASDAQ is QQQ, PSQ, and then QID is the 2X. And I put these 2X because those are actually the ones that I trade. I don't trade the 1X ETF, inverse ETFs. Even though I do a lot of bearish trades, and I short, and I buy puts and everything else, I love these top three, DXD, SDS, QID. I've got all three of them right now. I mean, I buy these. Even with all my bear market experience and all my bearish strategies, I still buy these. The Russell, the short funds are RWM and SRT, SRTY. I threw a couple others up here, Treasuries, TTT, financial sectors, SEF and FAZ, and the energy is ERY. But the point is, you can buy these inverse funds and you already know what to do with them. You just use the same signals. This is QID. Use the same signals that we used yesterday with the SPY. Just going to do it with an inverse ETF. You already know how to do it. In fact, that's the way most of this is. As you become better and better and you trust yourself more to manage your own money, you're going to realize you already know what to do. You just don't believe it. Or maybe you believe it, but you're self-sabotaging along the way. We're just going to try to simplify that and clean it out. In fact, most of my coaching sessions that I do with my private clients is actually cutting stuff out. It's simplifying. The vast majority of my clients, whenever I work with them on one-on-one coaching, the vast majority, it's not teaching them new stuff. It's getting rid of stuff. Trading can be simple. Trading is simple if you let it be. But we as humans, here's what happens. As human beings, we do more to avoid pain than we do to gain pleasure. So because we want to avoid pain, because we've had those drawdowns here, we've had losses here and there, because we've had those pain, what we do is we start to put rules up and we kind of put ourselves in an iron box where we have no room to move. And then we have these rules. This has to happen. And then this has to happen. This has to happen. This has to happen. And then when all that happens, then I'm going to go. And I'm going to be safe. And I'm not going to lose a bunch of money. When in reality, it can be as simple as just buying when we're above the average and getting out when we're below the average. It really can be, it really is that simple. All right, so I've just given you a bear market strategy. How much could that impact in a beneficial way? How much could that help your cash flow? Well, it can help it a lot, but it's not really going to give you monthly cash flow. What it will do is it will position you to really participate in big bearish trends. And here's the fact about bear markets. And I'll just give you some facts that most people don't tell you. And this is frankly why traditional fund managers get away with the heinous act of just buying and holding. On average, a typical bear market is less than 9 months on average. The average bearish swing is only 3 to 4 months. It's not even a bear market. It's just a 3 to 4 month down cycle, and then we continue. Because of that, traditional financial planners get away with this heinous idea that we're going to buy and hold. And because we only have the big one about every 8 to 10 years, they get away with it. And then every 8 to 10 years, you have the big one. And they tell everybody, oh, this is an outlier. They come up with these marketing stories. They get people to keep their money invested. And then before you know it, we've just survived another decade of heinous money management. I forgot where I was going with that. Oh, bear market. Bear market cycles, on average, typical bearish swing is only about 3 to 4 months. An average bear market is 9 months. A big bear market, like what we're in right now, typically is around 12 to 18 months. Just some interesting information. Why is that relevant? It's relevant because if you're trying to switch to bear strategies in a short bear market, by the time you figure out the market's bearish, it's too late. That's why I have found that except for the big 10-year outliers, you know, the 2008 cycle, the 2022 cycle, the 2001, 2002 cycle, it's about an 8 to 10-year cycle where you have that really, really big, prolonged 18-month bear market. Outside of those cycles, it's really more effective over time just to go to cash. I'm not saying buy and hold. I'm saying buy and go to cash. Buy, go to cash. Instead of trying to position in an inverse fund for every bear market, just go to cash or take a small inverse fund position, but don't do your whole account. Okay? That's a very, very important pro tip I just gave you. So we're talking about kind of big picture portfolio management with these big picture ideas. I want to get into something for granular cash flow. How can we make money every month? How can we make money every 2 weeks, every week with our trades? The stocks that we hold in our portfolio, the ETFs that we hold, whatever it is that you have in your portfolio, how can we make monthly cash flow? And I'm going to give you 2 techniques right now. All right, so we're going to talk about the sideways market. Remember, markets move 3 directions, up, down, and sideways. And we have to be prepared for each of those markets. If we're not prepared for a sideways market, we're just going to be sitting through it. In some cases, you'll be whipsawing. You'll be getting in and getting out and getting in and getting out. And you'll be really annoyed because you're constantly getting in and getting out. And you're losing money when you get out and you're buying in higher. It'd be really frustrating. Sideways markets drive people nuts, right? If all markets were simply bullish or bearish, everybody would be multi-billionaires. It'd be so easy. But it's these stupid sideways markets that just get everybody messed up. So you're going to have a sideways market. In that sideways market, we have to recognize that everything changes. Our analysis tools change and our strategies have to change. So how can we make money when the market's not going anywhere, when there is no trend? And the answer is selling options. Now, I know some of you are like, oh, I don't want to be an options trader. Well, just hear me out. I'm not saying you have to go buy calls and puts, and I'm not saying you have to take highly leveraged positions, and I'm not saying that you have to deal with a whole bunch of time decay working against you and all the bad stuff that people hate about options. I'm not saying you need to deal with that. What I'm saying is take the part that is the weakest part of the option, which is time decay, and use that in your favor. So for those of you who are not that familiar with options trading, you have to understand that when you buy an option, time is always working against you. So the time is the enemy of the option buyer. But time is the friend of the options seller. The very thing that people consider very risky about options is the very aspect of options that an option seller exploits. You use it to your advantage. And when the market's not going anywhere, it works perfect for you. Take a look at this chart. This is a chart of well, there's 2 things here. The bottom line is your option value over time if the price of the underlying stock does not move. The top line is the rate of time decay. It's how fast the premium erodes out of the option. You can see on the right side, top right corner here, I don't know if you can see where I'm circling my mouse up here, but it erodes very, very quickly those last 2 or 3 weeks to expiration. That's an ideal time to be selling options. Because what you're doing is you're taking the weakest part of the option and you're using it to your advantage. Options give the option buyer the right, but not the obligation to do something, to either buy or to sell the underlying stock. That's what an option is if you've not traded options before. What that does for the option buyers, it gives you control without actually buying the option, without actually buying the stock. Very, very cool. I mean, and look, I'm an options trader. I've been trading options for almost 20 years. I love options. I love them. Okay. But the negative part of options is this thing we call time. Options expire. You pay a premium to get the option, and from the moment you buy it, it's losing value in the form of time decay. So if you don't have a rapidly moving trend underneath it, that option is just going to go to zero eventually. Okay? The option seller exploits that. So when I'm talking about for you right now, what I'm talking about for cash flow is let's sell these options. Let's put cash in our pocket by selling them. Call options are the right to buy the stock. When you sell somebody else that call option, you're giving them the right to buy your stock at a specific price. In other words, you're giving them control over it. Now, the metaphor that I use for this, that most of us use, we've been using it for many years now, is the metaphor of renting your house. If you have a home and you rent it to somebody else, do you still own the home? Yes or yes? Yes, we still own the home. Okay, so if you rent your house out, you still own it. Do you have control of the house? Well, kind of. I mean, I could go sell it anytime I want to, right? Yes, you could. But you're giving somebody else the right to use it. Yeah, they're paying me for that. They're paying me rent. Yeah, that's exactly right. When we sell call options, we're essentially doing the same thing. We're giving somebody else the right to your stock with also the option to buy it if they want to. But as long as you meet certain criteria, they're not going to want to. And what happens then is the time decay of that option works in your favor. Time is the friend of the option seller. It's the enemy of the option buyer. It's the friend of the option seller. And the technique we use for this is something we call a covered call. When you own the stock, which you guys are doing, because that's what I'm teaching you to do here. When you own the stock, you can sell somebody else the right to buy that stock. And you can just trade out the word stock with the phrase ETF. When you have an ETF, which is a stock, you can sell somebody else the right to buy that ETF. And in exchange for that, you get paid a premium. That premium is yours. You get to keep it. Now, don't worry. If something happens and you sell your stock, you can always buy it back. It's not like this is a situation where you can't ever get your stock back. Okay, this is actually a way to maximize your profits. So let me show you here. I'm going to go over here. I don't know if you can see this option chain very well, but if you've never traded options, just kind of trust me a little bit. Let me show you what's happening here. Let's say on this SPY trade, we chose to sell a call that was about $10 out of the money. Say we chose a $3.90, you can get about $2.40 a share for that option. This is 2 weeks to expiration, so you're only doing this trade for 2 weeks. So if you bring in $2.40, every option contract is 100 shares, so you bring in $240. Now, if you did the math on that, which I have done for you, that's a little bit better than 0.5% every 2 weeks. It works out to about 1%, maybe a little bit better, every month. That's 12% a year. How many of you have a financial planner friend, somebody who works for you as your financial planner, who has told you 10 or 12, 15% a year is a really good job? You did good. This is a technique that you can do that. And it's a guarantee. You say, how's it guarantee? Well, because when you sell that premium, you receive it. You're guaranteed to keep that premium unless you choose to do something to remove your opportunity for the guarantee. But if you sell the premium, you're going to keep that premium. You're guaranteed 1% or whatever the premium is. You're guaranteed that premium. If the stock goes down, you keep the premium. If the stock stays the same price, you keep the premium. And you keep your stock or your ETF. What if the trade goes up? If the trade goes up, you keep your premium. It's a guarantee. you might end up selling your stock. And if you don't want to sell your stock, you might choose to take some sort of a maneuver that would prevent the sale of the stock, and you may end up costing more than your premium or costing about your premium. So in that case, you would not get your premium, but you made money for the stock because the stock went up. That's why people love covered calls. This is one of the safest option strategies that you can implement. It's one of the best ways to increase your income in a sideways market. It does not add additional risk to your trade. It's a guarantee of premium received, and it pays better than a dividend, and it's predictable income. And I have many students who use this technique right here to pay their mortgage every month. I have one, I won't mention his name just in case he didn't want it to be mentioned. But I have one student who over the years, using this technique and the next one I'm about to teach you, has built up a huge holding in about 4 or 5 different combination of ETFs and stocks. He's got about, like I say, 4 or 5. It started off with a simple 100-share position. And he kept selling his covered calls, and he would do the next strategy I'm going to teach you here in a minute, and he would get more shares, and then he would sell some more calls, and he would use that to buy more shares until eventually he has in each of these over 10,000 shares in each of those 4 or 5 positions. Then he turns around. Imagine you're making $2.40 per share every time you do this, times 10,000 shares on 4 or 5 positions. He sells his positions once a month. He gets his premium. He collects it. He withdraws it from his trading account. He pays his bills, and he goes on with his life. This is a cash flow strategy. And guess what? His portfolio doesn't go down. He just takes the profit off, takes the cash flow off from this little strategy. This is a technique. Look, many people have $200,000, $300,000, $400,000 in your trading accounts and your retirement accounts, and you're sitting here saying, how can I possibly survive retirement? I don't have enough, because those traditional financial planners told you needed to have a few 7 figures. You don't. You don't have to have a few 7 figures. You have to have a few better strategies and a few better techniques. And if you learn to do that, then you can actually bring in the cash flow on a $200,000 account or a $300,000 account. What if you're sitting here and you're like, well, I don't have that. I have a $10,000 account. Well, great. There's strategies to help you for that too. So regardless of where you are, you just have to find the right strategies to fit your profile where you are, grow that account so that you can bring in that cash flow. Okay? This is a great, great, great cash flow technique. And like I say, I got a lot of students, a lot of clients that use this technique exclusively to pay for their retirement. This is their job. And no, it's not day trading. You can manage this trade in about 2, maybe 3 hours a month. I mean, it just doesn't take any time. This is a very, very simple strategy. All right, let's rotate that. Rob says, that's all good and well until the stock drops huge and then you still sell calls and it happens to go up and you lock in the huge losses. Well, that's where you've got to learn how to make some of the adjustments. And one of those adjustments is actually what we're looking at right here. If you do end up taking that loss, Rob, then you rebuild your position getting paid. You can get paid up front, just like this right here. Or if the trade is moving up and you're going to get called out of your trade, Rob, you can buy to close that option, keep your position. There's so many ways that you can manage it. So there you have it. What if you could get paid before you place the trade? How cool would that be? Okay. If I told you you're going to get, you're going to go buy some stock, you're ready to write your check for it. But I told you before you write the check to buy your SPY position or your QQQ position or whatever it is you're going to buy. What if I told you, I'm just going to pay you $500 right now? And then you can buy it like in 2 or 3 weeks instead. Would you be cool with that? Would you be cool with getting paid today to do something you were already going to do? Yeah, that'd be pretty cool. All right. What if you're in a situation like this? You're getting a buy signal. You're back above the averages and you're saying, you know what? That looks like a good deal. So I'm going to buy, I forgot what chart this is. This is diamonds. I'm going to buy diamonds here at $324 a share. Okay, so let's say that you're going to do that. you would spend $32,400 if you buy the exchange traded fund. You're going to, for 100 shares, you can put $32,400 into this trade. Now, I know if you have a $10,000 trading account right now, you're saying, I'm not going to do that. I don't have $32,000. I know. I'm not talking to you. I'm talking to the people that are going to do this, because the ideal person for this ETF model that I'm teaching you is somebody who's managing $200,000, $300,000, $400,000 with your retirement account. Okay. If you're the $10,000 account, we have different techniques for that. So let's assume that you're going to buy 100 shares of diamonds at $324 a share. It's $32,400. Now, we're going to spend that money today, right? Alternately, instead of buying the stock, what if we sold a put? You say, what is a put? A put is the option. It's a stock option that gives the buyer the right to sell a stock. It's the opposite of a call option. Instead of giving you the right to buy the stock, it's going to give you the right to sell the stock. Now, I don't need you to understand all of this at this moment. I just want you to understand the concept, okay? The put buyer has the right to sell the stock. The put seller becomes obligated to buy the stock. Well, you were going to buy it anyway. So what if you become a put seller? You become obligated to do what you were already willing to obligate yourself to do, and you get paid for it. The put seller gets paid up front. Again, it's a guaranteed premium. Get paid up front to take on that obligation. And just like with the covered call, it is a guaranteed premium. Let's take a look at this. Let's say that we were to do this. Remember, we were going to buy at $324. Well, let's do a put option a little bit lower than that, maybe around $320. You can receive $4.10 a share for that trade. That's $410 on 100 shares. Get paid up front. And not only that, you have the obligation to buy it at a better price. This is a guaranteed premium. If the stock goes up, you keep the premium. If the stock stays the same price, you keep the premium. If the stock goes down, you keep the premium, and you end up buying the stock you were already going to buy, but instead of buying it for $324 a share, you're buying it for $320 a share, plus you got $4.10 a share to do that. Now, if you're doing your math quickly on the top of your head and you know anything about cost basis, you realize that instead of having a cost basis of $324, by doing this little maneuver, you ended up with a cost basis of $316. $8 better. You can receive $410 on day one, or you can spend $32,400 on day one. The end result is you make money, right? If you buy it at $32,400 and it goes up, fantastic, you make money. If you sell the put and it goes up, fantastic, you make money. If you sell the put and it stays the same price, you make money. If you buy the stock and it stays the same price, you didn't make any money. You sell the put and the stock comes down, you buy the stock you were already going to buy, but you got paid to do it. This technique, mixed with the covered call, is the technique that the previous customer that I mentioned uses. This is what he has used to acquire thousands and thousands of shares of stocks and ETFs. What he does when he decides he's going to take a position, he starts with however many he can afford to start with. He uses these two techniques to bring in the cash flow, selling the options, bring in the cash flow to build a 10,000 share position. And then he just sells covered calls against it for his cash flow. It's a great trading strategy. Great technique. Now, there's a lot more to trading options than what I've just shared with you here. Obviously, I can't cover it all in a 1-hour presentation, certainly not in a 1-hour presentation where my live stream keeps dropping. I just want you to see what's possible with exchange-traded funds in general. And because it's an ETF, we also open up the door to all these additional cash flow strategies, the inverse strategies, the bear market strategies. We open ourselves to so much opportunity, and I'm actually just scratching the surface. Going back to day number 1 of this challenge, can you see why ETFs are so much better than mutual funds? Can you see why? We can time the trade better. We can get in and out easily. We can manage all sorts of directions of the market very easily. We can sell options on it. We can bring in monthly cash flow. There's so much more that you can do with an ETF, with an exchange traded fund. There's so much more you can do with this than you can with a mutual fund. That's why I think it's far superior. And that's why I think that, if you're trying to manage your own portfolio, this is the better tool. By far, it's the better tool. If you're not trying to manage your own portfolio, I think you still owe it to yourself to look into these techniques and ask yourself, why am I not managing my own portfolio? Do you really not trust yourself that much? You just don't want to mess with it. The question is, what would it be worth if you did know all this information? And as I shared with you the other day, depending on the size of your portfolio, recently in 2022, we've had a 25% drawdown. According to the statistics, 95% of Americans have done nothing, and they are suffering through a 25% drawdown on average. Okay, so if you had a $100,000 portfolio, that's $25,000 in drawdown. If it's a $250,000 portfolio, it's $62,000. It's $500,000 portfolio, it's $125,000. $1 million is $250,000. Okay, most of you, your fund managers, are charging you a management fee of around 2%. That's what the numbers look like. So if you add just those two factors together, a $100,000 account, knowing this, is probably worth a savings of at least $27,000 or more. That's not to mention the upside potential. That's what you'd be missing out on, but just the savings. Now, remember my client that I told you about yesterday? She's had the same fund manager for 25 years for her retirement account, and she's decided to start doing it on her own because after 25 years, he hasn't grown her money. But I asked her, I said, how much is he charging you for fees? And she said, oh, it's not much. I said, well, how much? She said, oh, it's $1,000 a quarter. I said, really? That's it? $1,000 a quarter. How much is your account? And she told me. Guess what? It's 2%. Getting 2% a year. 1.5%, I think in his case, it was like 1.5%, a little bit less. But still, the way that they work these in is they charge you a little bit every month for the management or a little bit every quarter. So you don't realize that you're paying $4,000 a year, $5,000 a year, $8,000 a year. The bigger your account, the more you're paying. And it's sitting there in one of those little line items. They're taking money out because they don't make money when the market goes up. They don't make money when the market goes down. They make money when they have your money and they charge you these fees. That's how they make their money. So with this information, the question is now what? What do we do now? I want to share with you really quickly here kind of my model that I teach everybody. It's the three keys to trading profitably. And this will just take a couple of minutes. There's three aspects to trading profitably. Number one is the analysis process. And we talked about that 2 days ago. I taught you a very simple analysis process. I called it the simplest trading strategy ever. You just simply buy whenever we're over the moving averages and we get out of the trade when we're below the averages. It's a very, very easy analysis process to determine the direction. Now, there's a lot more to that. Whenever I teach people the full analysis process, I go into additional aspects for determining market direction and market structure and other things. But even if you don't have that, just what you've learned here in this ETF course, you have learned how to pick the direction of the trade. Okay. Now, the second technique, the second key to trading profitably is to have a strategy, have the right strategy. Once you've determined the direction of the trade, now we can apply that strategy. If you know the market's going up, you have a strategy for that. If you know the market's going down, you have a strategy for that. It's inverse funds. Or just go to cash, right? Now you got a strategy. If you know the market's going sideways, now you have a strategy for that. We can go sell the options. Wow, we really can trade in any market condition. So it's easy once you know the direction of the trade. But if you don't identify the analysis first and figure out the direction of the trade, then you won't be able to apply the appropriate strategy. Once we have those two pieces in place, everything else is management. Everything else is just easy. We're just managing the risk. And this is how we make sure that we don't lose all of our capital. Okay? Those are the three aspects. If there was a fourth aspect, it's the psychological aspect. That encompasses all of it. I can't really teach that in a bunch of bullet points, so I never put it on here because it's not like I can sit here and say, well, here's how you have a better mindset for trading. I can't do that because this is not how it works. I can teach you philosophy. I can teach you mental strategy, but we can't really do a slide for it. So I can't like put it into the curriculum that way. This I can teach you as a very black and white philosophy. And this is exactly what I teach my private coaching clients. This is what I teach in my classes. When you come over to trademaestro.com and you learn from all the stuff that I put out there. And for those of you who are going to be joining me next week for our Market Maestro Accelerator, this is what I'm teaching you. This is the most complete training I've ever done. It's everything I'm teaching here and all of the complete stuff that we do. It's a big program. By the time you get done with this accelerator, you are going to know how to trade and how to manage your own individual trading accounts. The same way that you've been seeing me teach you here for the last 3 days, you're going to know how to do that. Okay? So let me tell you what you're going to learn. You're going to learn, number one, the analysis. You're going to learn the analysis. I'm going to walk you through 5 steps of trade analysis. We're going to go through the moving averages in great detail. I'm going to teach you the trends in great detail. I'm going to teach you the chart patterns and the candle patterns in great detail. I'm going to teach you how to identify your buying and your selling zones. I'm going to teach you the market structure with support and resistance. We're going to teach you how to use indicators. And when you are done, you will know how to tell if the stock is moving up, down, or sideways. And you're going to know when you should buy and when you should sell for any stock or any ETF at any time. And you do not need to look at the ratings in Morningstar. You do not need to turn on CNBC or Fox Business and listen to the latest talking head. You will have that knowledge in you. You will have the ability to do it. Okay? That's the first thing you're going to learn. Second thing you're going to learn is the strategies. I'm going to teach you 6 of the most powerful strategies available, both bullish and bearish strategy techniques. I'm going to teach you stock strategies. I'm going to teach you option strategies and option selling. The same stuff that I started teaching you here, I'm going to teach it to you in great detail. And by the end of this training, you're going to have the ability to pick a trading strategy that you can apply in any market condition. If it's bullish market, if it's a bearish market, if it's a sideways market, you will have a strategy that you can implement for that. Okay? So the second thing you're going to learn. Third thing you're going to learn is your risk management piece. You're going to learn how to not go broke. You're going to learn how to protect your capital. You're going to learn the 3 levers of risk management. You're going to learn how to scale your risk. You're going to learn trade management and stops. And by the time you're done with this, you're going to be able to see that you will have the knowledge needed to pick the direction, apply the strategy, and manage your risk. So the question is for you, looking at your trading account, looking at the experience that you've had over the last however many months, many years you've been trading, possibly a fund manager doing the work for you, what would this be worth to you? I don't know. If you have a $10,000 account, it's worth different than if you have $100,000. If you have $1 million account, it's worth different. And the question I ask, I'm not even asking you to take these trades. I'm asking you to educate yourself and learn. I'm not asking you to go manage your own money. I'm saying it's worth something to learn more. If what you've been doing has not been growing your account at least 15, 20, 30% a year and preventing the market downside, if you have not seen that kind of a growth, then it's worth learning, right? In this accelerator, we're going to go through 24 modules. That's like so much more than what we've learned in the last 3 days. Just whatever that is, 8 times more. We're going to go through, you're going to have live group coaching. You're going to get all the recordings, everything that you need to do this. It's all included in the accelerator. So if you're looking at this and you say, you know, I really want to learn how to analyze a stock and make the most profitable trade. I really want to know exactly when a trend is rising, when a trend is falling. I want to know the right risk management. I want to know how to avoid those devastating market reversals. If that describes you, this is the perfect training for you. Okay. And right now, as I said yesterday, I've got an early bird promotion. The early bird is running out because we're starting the preliminary stuff next week, like in just a couple of days. Right now, it's $6.97. I always teach you to buy low and sell high. That's where we are. We've already had a couple price increases. We're about to hit full price here. So this is the time to jump in and get the early exclusive early bird. Okay. Today, it's only $6.97. You can do that at trademaestro.com/MMA. There's also links on the, well, I don't know if anybody's watching on YouTube because I think I lost the stream, but I'll put the links in there if it's not. 3 months group coaching. Here's a bonus. As a bonus for doing this, you can get 3 months of group coaching. It's a $1,500 value. You get to come in and talk on the microphone, and it's live group coaching. You're going to get training, access to my Trading View training, so you can do all the charting that I teach you. I'm going to give that to you for free. And I'm going to give you an audio series called Wired for Wealth. It's worth $100. It's $1,850 in bonuses. It's all included for the $697. As I said, time is running out. So if you've not taken action on this, and I know some of you haven't, some of you, I see some names in here of people that have, but Many of you have not. So if you're sitting here on the fence, you're like, should I do this? Well, I don't know. Here's what you get. I think you should do it. You get the full Market Maestro Accelerator. That's $29.95 value. You get live group coaching, recordings included. That's all included in the Accelerator. You get the bonuses. You get 3 months of group coaching. It's $1,500 value. You get the Trading View training, another $250 value. You get the Wired for Wealth audio. It's another $100 value. That's over $4,800 in value, all for $697. And I promise you at the end of the day tomorrow, because this early bird is running out tomorrow, at the end of the day, it's going to be more expensive, I promise. Okay? So what if all you get from this is the ability to avoid the devastating drawdowns? Would it be worth it for you? I don't know. Probably. I think it would be. I remember 20 years ago, it was exactly 21 years ago, because it was the year 2001, when I took my very first class. When I took my very first class trading, I had been trading for 2 years and I had already blown out 2 trading accounts. I had already spent over $10,000 real money trying to trade the market and losing. And I took my very first training, which was not as advanced as what I'm giving you here. And I paid $6,000 for it. Put it on credit cards, and I didn't have the money for it. I put it on credit cards because I knew I had to learn more. Okay? Was it worth it? I don't know. You tell me. I mean, it turned into a career for me, right? So what if all you did was avoid the devastating drawdowns? For some of you, that's $10,000, $25,000, $50,000. One client I'm working with right now, it's $600,000 that her professional fund managers have devastated her account because they didn't get her out. What if you avoid paying those 2% annual fees? That could be $1,000 a quarter in the one case of the one client I mentioned. For some of you, that's $2,000 a year. Some of you, it's $10,000, $20,000, $30,000 a year. It just depends on how much money you've got under management. What if all you get out of this is the ability to feel more informed so that you can communicate with your managers and tell them what you want to do with your money? Would it be worth it? Let me tell you about that client I was talking about yesterday. So she told me yesterday, based on our conversations, she called her fund manager, the guy who's managed her money for over 25 years, the guy who's not made her any money. She called him and she said, I want to go to cash. And he argued with her. He said, no, you don't want to do that. You don't want to go to cash. This is the time to buy. She said, I want to go to cash. Close all my positions and put me in cash. And he argued with her and he commenced to argue with her. She said, you put me in cash or I'm taking all my money. And he put her in cash. He called her back this week and said, you got to buy some more. You got to buy some more. This is the time to buy. And she said, I want to be in cash. And she told me she said, if I hadn't done that, she did that about 6 weeks ago. She said, if I hadn't done that, I would be down another $30,000. How much would this knowledge be worth? Because she's informed, she's seeing what's happening in the market. And she also told me that she took her charts that I've taught her and she took them to him. She said, let me show you what I'm looking at. And his response was, where'd you learn to do this? Who taught you this? She said, I have a mentor. She left it at that. I said, I'll let you tell him that. $697 today's investment. All you need to do is go to trademaestro.com/MMA, Market Maestro Accelerator. We're starting next week with the preliminary stuff. The really intense stuff will start in 2 weeks. If you have any questions, reach out, help@trademaestro.com. Help@trademaestro.com. You can find us over at trademaestro.com. Again, the web address is trademaestro.com. I do have a link on the homepage there, but just trademaestro.com/MMA will take you straight to the accelerator. Again, if you have any questions, just reach out, help@trademaestro.com. I'll be happy to answer them. All right, folks, thank you for being here. I'm sorry for a couple of live stream issues. I'll probably have to do another one of these so that we have a good recording because obviously we had some issues today. But I hope you guys have learned some stuff. I hope at the very least it's opened your eyes to some of the stuff that you can do. And I hope you're excited about it. And I really hope you join us for the accelerator because I know how much it's going to transform your life and just give you so many more tools and so much more ability to manage your money. And that's what I do. And that's what I teach people to do. I've been doing it for 15 years almost. And, it's just really awesome. What I live for is the testimony. It's not the money. I live for the stories that I get of people like some of the stories I'm telling you here. The people that say, hey, because of this, I avoided $30,000 in pain. Because of this, I made an extra $20,000 here. I made an extra whatever over there. Those are the stories that I live for. So that's what keeps me motivated. That's what keeps me going and doing it. And if you don't join me for this stuff, then I can't teach you, so you don't have those stories to share with me. All right. So I hope to see you guys next week when we start the accelerator. Like I say, if you have any questions, just feel free to reach out, help@trademaestro.com. Fanny put in here, excellent work. Thank you. Appreciate that. And I will look forward to seeing all of you next week in the accelerator. And if you can't do it for some reason, then at least stay engaged. If you're still watching on YouTube, I don't know if we're still live on YouTube, but if we are still live and you want to learn more, obviously click on the subscribe button, because you need to be subscribed so you get all these alerts and everything. I think everybody that's watching is on the website right now because of the live stream issues. So anyway, you guys have a wonderful remainder to your day. I look forward to next time we meet. And until then, happy trading. We'll talk to you soon.